Welcome to the video. Today we'll explore why strong earnings can paradoxically lead to weaker wealth if you prioritize investing over eliminating high-interest debt. We'll use a practical scenario. A $64,000 income, $37,000 in total debts including a 6.2% car loan, $16,000 invested in an S&P 500 taxable account, and a $3,000 emergency fund. As we move through the video, we'll transition from understanding the trap to the mathematics behind guaranteed returns from debt payoff, to building an emergency fund, to prioritizing tax-advantaged accounts, and finally to a future-proofed Roth strategy during low-income years like law school under the GI Bill. Stick around for quizzes to test your understanding and a step-by-step plan. Here's our agenda. First, we'll define the high-earning trap and why it happens. Next, we'll compare the guaranteed return from paying off high-interest debt with the uncertain returns from the stock market. After that, we'll cover building an adequate emergency fund and then prioritizing tax-advantaged accounts over taxable investing. We'll also discuss how to future-proof your plan using a Roth strategy during anticipated low-income years, such as when using the GI Bill for law school. Then, we'll bring it all together with an action plan and timelines. Finally, we'll include a couple of short quizzes to reinforce your understanding. Before we get too deep, an important disclaimer. This video is educational and is not financial, legal, or tax advice. Your situation is unique, and you should consult qualified professionals for personalized recommendations. With that said, let's move forward and apply these principles thoughtfully to your own numbers. Let's begin with the trap. You're earning, well, say, $64,000. So it feels appropriate to invest aggressively. However, continuing to invest in a taxable account while carrying 5 to 6% interest debt quietly drains your wealth. The interest you pay is certain. The market returns are uncertain. Therefore, the higher interest debt acts like a guaranteed negative return. We'll unpack this next. This diagram shows your choice of where extra dollars go. If those dollars go to a 6.2% loan, it's equivalent to earning a risk-free 6.2% return by eliminating that cost. If those dollars go to the stock market instead, the return is uncertain and taxable, and meanwhile the loan's interest keeps compounding. Consequently, when your debt interest rates are 5% or higher, the mathematically dominant move is to pay the debt first. Once that drag is removed, you free up cash flow and reduce risk, which sets you up to invest more effectively later. Next, we'll compare the two approaches side by side. On the left, investing now might yield higher long-run returns, but the interest keeps compounding on your debt, creating a guaranteed cost. You may also incur taxes on dividends and capital gains in a taxable account, all while dealing with market volatility. On the right, paying debt first provides a guaranteed benefit at 5 to 6.2%, which is compelling when compared to uncertain market outcomes. It also simplifies your balance sheet, lowers your required monthly payments, and unlocks future cash flow that can be redirected to investing. Therefore, when high-interest debt exists, the right side usually dominates. Immediately, you should target the highest interest loan, in this case, the 6.2% car loan. Paying it off is a risk-free 6.2% return. Next, aggressively pay down all debts that carry rates of 5% or higher. During this period, strongly consider pausing taxable investing. The threshold to consider resuming taxable investing is when your remaining debt's interest rates are under roughly 4%. This sequence reduces guaranteed losses, stabilizes cash flow, and positions you to invest more consistently later. Now let's map a realistic timeline. This timeline shows the phased approach. In months 0 through 3, you make minimum payments on all debts but direct all extra cash to the 6.2% car loan. From months 3 through 9, you continue with a snowball or avalanche method on remaining debts above 5% until they are eliminated. Starting around month 2 through month 8, you simultaneously build the emergency fund from $3,000 toward at least 3 months of expenses. Then, by months 12 to 18, you push the emergency fund to 6 months. Once all high-interest debts are gone, you immediately capture any employer 401k match and begin or increase Roth IRA contributions. Finally, after the emergency fund and tax-advantaged contributions are on track, you resume contributions to a taxable brokerage account. To build an emergency fund, first calculate your essential monthly costs, including rent, groceries, transportation, insurance, and minimum debt payments. Next, Save rapidly to 3 months of these expenses, and then aim for 6 months over time. Keep the fund liquid and safe, typically in a high-yield savings account or money market account. Automate transfers on payday to ensure consistent progress. If you ever draw from the fund, prioritize refilling it to the target level. This buffer prevents you from using high-interest credit in emergencies and stabilizes your plan as you eliminate debt and begin investing. Here are example targets for an emergency fund based on different essential monthly expense levels. If your essentials are $2,200 per month, 3 months would be $6,600, and 6 months would be $13,200. At $2,800 per month, the targets are $8,400 and $16,800. At $3,500, the targets are $10,500 and $21,000. Use your own numbers to set precise goals. Now that you understand the priority of eliminating high-interest debt, let's turn to investing accounts. If you must invest, prioritize tax-advantaged vehicles over taxable accounts. Capture any employer 401k match first because it's essentially free money. Then use Roth IRA or traditional IRA depending on eligibility and tax considerations. The goal is to build tax-free or tax-deferred growth before contributing to a taxable brokerage account. This ordering materially improves long-term outcomes. This mind map shows the standard priority stack. First, capture your employer 401k match because it's effectively a risk-free, immediate return. Second, eliminate debts above 5% because that payoff is a guaranteed benefit. Third, if eligible, contribute to a health savings account due to its triple tax advantage. Fourth, fund a Roth IRA to the annual limit as it provides tax-free growth and tax-free qualified withdrawals in retirement. Fifth, if you still have capacity, contribute further to your 401k up to the annual limit. Finally, once these steps are covered, add to a taxable brokerage account for additional flexibility and goals. If you anticipate a period of low or no earned income, for example, while in law school, using the GI Bill, you can future-proof your plan by leaning into Roth strategies. Contributing to a Roth IRA while you're in a lower tax bracket can be especially valuable. Additionally, low-income years may allow you to realize long-term capital gains at a 0% tax rate, depending on your taxable income. Some individuals also consider Roth conversions during these years to move money from pre-tax to Roth at a relatively low tax cost, which then grows tax-free. This forward-looking approach can materially improve lifetime after-tax wealth. Next, let's test your understanding. Quiz time. The question is, if your car loan is at 6.2% APR, what is the guaranteed return from paying it off? Is it A, 3.1%, B, 6.2%, C, it depends on the stock market, or D, 10%? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, 6.2%. Paying off a 6.2% loan is equivalent to earning a risk-free 6.2% return, because you are eliminating a guaranteed cost that would otherwise compound against you. Second quiz. Which ordering best aligns with the recommended priority? Is it A, taxable investing, then the 401k match, and then paying 5% plus debt? B, 401k match, then pay 5% plus debt, then Roth IRA, then taxable? C, pay 5% plus debt, then taxable, then Roth IRA, then 401k match? Or D, HSA last and taxable first? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. First, capture the 401k match. Next, eliminate debts above 5%. Then, fund a Roth IRA. Finally, contribute to a taxable brokerage once those priorities are met. Here's a concise action plan. From months 0 to 3, pay minimums on all debts and direct every extra dollar to the 6.2% loan. From months 2 to 8, build the emergency fund to at least 3 months, essential expenses, keeping it liquid. From months 3 to 9, eliminate all debts above 5% and free up cash flow for the next steps. Starting around month 3 and continuing onward, always capture your employer 401k match. After the high-interest debts are gone, fund the Roth IRA, and, if possible, Increase 401k contributions. Once the emergency fund is between 3 and 6 months, you can resume taxable investing as the final step. This structure balances certainty and growth while protecting against emergencies. These are the key takeaways. First, debt above 5% is a guaranteed drag and should be prioritized. Second, a 3 to 6 month emergency fund stabilizes your plan. Third, prioritize tax-advantaged accounts over taxable investing. Capture the 401k match, then fund Roth, and only then allocate to taxable. Fourth, low-income years present Roth opportunities, including the 0% long-term capital gains bracket and possible Roth conversions. Finally, after you stop the bleed by eliminating high-interest debt, you'll be positioned to invest more and with greater confidence. To wrap up, prioritize guaranteed wins, like eliminating high-interest debt over uncertain market bets in taxable accounts. Then, focus on liquidity through an adequate emergency fund. Next, optimize taxes using 401k, HSA if eligible, and Roth IRA before contributing to taxable. Finally, align your plan to anticipated changes in income, such as during school, to exploit Roth advantages. This sequence helps you protect your downside and accelerate your long-term upside. Thanks for watching. If this helped you avoid the high-earning trap, please like the video, share it with a friend who might need it, and subscribe for more practical money strategies. What's your next step? Debt payoff, emergency fund, or Roth contributions? Let us know in the comments.